AI is obviously a trend that a lot of investors are looking to capitalize on, and that is exactly what I'm looking at today. I'm not looking to capitalize directly in AI, I'm looking to capitalize into supporting industries around AI. In this case, namely energy. Energy has been a major topic lately. Trump just started a new speed to power initiative where he is pushing for more power in the economy, where he's wanting to see more electricity because we're going to need a lot of power to power all of this AI, all of this data center expansion. So that's what I'm looking to capitalize on. And this is the company right here. Essentially, my approach this week, this is my public YouTube portfolio series where I invest in a different company every single week. Typically, I invest $100. The portfolio has done very well. I'm very happy with it. We'll take a quick look at the portfolio. So like I said, a different company every single week. We're over 30 companies now. And here is the YouTube portfolio compared to the other benchmarks this year. We're up 22.5%. Total world is up 18. Core growth, iShares fund is up 12, and the S&P is up 13-14%. So we're outperforming the S&P 500 with over 30 holdings. So I'll just go quickly to the holdings so we can see. We got 33 holdings. So a lot of holdings. We haven't just beat the S&P 500 by picking just a couple companies and gotten lucky. We've been consistently picking strong companies. So we're looking to continue that today with the discounted future free cash flow method. That is what I like to use. I like to look at free cash flow because that is the chunk of money that is returned to shareholders. Companies will use their free cash flow to pay dividends, buy back shares, fund their growth, pay back debt. That is the sum of money that gets returned to me. And I'm wanting to see companies that are growing their free cash flow the fastest and then reinvesting their free cash flow in a good way. So this is where this company gets a little bit interesting. So this is a utilities company. Like I said, my approach was I used a stock screener. I'm looking at all market caps in any industry in the utilities sector. I want to see US companies, and I'm looking at operating cash flow. And I clicked through these companies until I found one, American Electric, who has quite a bit of data center exposure going forward and has really good growth forecast. That's one of the main things that I'm looking for in these companies is strong growth forecasting. And so right here, the upper end of these revenue projections are in the 20s and 30s in some cases, whereas the average analyst projections for revenue growth are in the upper single digit categories. So pretty strong revenue growth. When I look at their most recent investor handout here, we can see that they're really highlighting how much data center expansion they're seeing. So we got 11 billion in data centers for Amazon, 13 billion for Amazon here, 7 billion for Google, 4 billion for Nucor. I'm not familiar with that company, or I'm not even going to try to say this word, but 23 billion expansion, 1 billion for Tesla. Lots of data center expansion. So how does my free cash flow method work? Essentially, I'm looking to project the free cash flow going forward by looking at their free cash flow margin. Typically, their past free cash flow margin, I'll look at an average over the last 5 years, and then I'm looking at revenue projections going forward, multiplying those forward revenue projections from the analyst by my free cash flow margin to get a estimate of future free cash flow, and then I'm discounting that free cash flow by the appropriate discount rate. And let's actually refresh this discount rate. This is what I was using before. So in order to find the discount rate, I will type in AEP discount rate, and then I typically go to alphaspread.com, which, wouldn't you know it, is right here at the top. So they are saying the cost of equity is 7.28. However, I prefer to use a little bit more of a conservative approach. So typically the way this cost of equity is calculated is they will take the risk-free rate. This is like the 10-year treasury rate. They'll add to it the equity risk premium. This is the additional risk that you take on average investing in securities over like a treasury. But they'll take this equity risk premium and they'll multiply it by this company's volatility compared to the overall market. So in this case, it gets reduced, this 4.12, by 77, or it gets reduced by 23%. I don't like to reduce it by the volatility in the market. So I just add these two together. I take a higher discount rate than normal. It gives me more conservative projections, but I like that. So in this case, 4.11 plus 4.12 is 4.2 or 8.23. So I need to adjust this just a bit. Okay. So they've got a past free cash flow margin that is negative. So this is a first for this channel. I have not analyzed any companies yet that have negative past free cash flow margin. So what do I do here? If they have negative free cash flow margin and then I'm multiplying it by future revenue, then future free cash flow is just going to be negative. The company is obviously going to be worthless, and that is what my projections are saying right now. So my analyst high, average, and low, these just refer to the low, average, and high analyst projections that I pull off of stockanalysis.com right here. So revenue growth in 2025 through 2029. That's what these projections are. So it doesn't matter how much they're growing their revenue. If their free cash flow margin is negative, that's a no-go. So how do we deal with this? The problem with this is that this company is incredibly capital intensive. So let's go to their financials to see what exactly is going on here. When I go to the cash flow statement, okay, and I scroll down to the operating cash flow. So in order to calculate free cash flow and then to calculate free cash flow margin, you take the operating cash flow and then you subtract the capital expenditures. So in this case, free cash flow is negative. 6.5 billion minus 10 billion is a negative number. And then in order to calculate the free cash flow margin, you take the free cash flow divided by the revenue. And so it's still obviously a negative number. The problem here is that this capital expenditure, this isn't all lost money. This isn't all maintenance. A lot of this is growth. And so I have to figure out a way to separate what capital expenditure is maintenance and what capital expenditure is growth. One fast way to do that, it's not the most accurate, but it gives you a really good approximation, is to look at the depreciation and amortization. So this depreciation is what the accounting department of this company uses to spread out the cost of its depreciation. Now, this isn't going to be perfectly equal to the maintenance, but it'll be pretty close. Where you get into trouble with this is if a company has lots of really old assets that are still generating cash flow and they're still generating expenses, those assets might already be fully depreciated. So a lot of times a big asset, it might have a 30-year depreciation window or a 10-year depreciation window. And so they'll take the value of that asset, they'll divide it by 10 or 30, and then they'll depreciate it a little bit every year. So if an asset lasts longer than that window, then your depreciation is not going to represent the full maintenance amount. But like I said, it will get you pretty close. So initially, I'm going to use the depreciation and see what we come up with for this company. So down here at the bottom, I have calculated the percentage right here, the percentage of depreciation, which is growth. Or sorry, I take out the depreciation, and whatever is left on CapEx, I consider it to be growth. So in this case, for 2024, 60% of the capital expenditures could be proportioned to growth, which means I have to give them credit for 60%. So I have it automatically putting in 58, but we'll change the math. We'll do 60. And then the free cash flow margin for their most recent year, as they've had a lot more investment, is now 17.5% free cash flow margins. That means I can buff this value up quite a bit. So if I want to get it up to 17.5, that means I have to add 32%. And I know this is a little bit strange the way I do this. I should rewrite this cell to be just the straight up margin, but the way it's working now is it automatically uses the average, and then this is the cell that I use to add to it. So I'm adding 32% to 13.5 to give me 17.5. So with that adjustment in place, now the average analyst gives me a fair share price of $98 per share, and the highest analysts give me a fair share price of $271. So let's say the reality is maybe somewhere in between the average and the high, or let's just go with the average analyst for now. What this number tells me is that if I want an 8.23% return every year on this company in the long run, now these companies are going to be volatile, they're going to go up and down a lot in the short term, but if I want this return in the long run every year, then I should be willing to buy this company at $98 per share. The problem is, when I look at it, it's currently at 109.43. So it's been going up a lot in price lately. So if I look at, let's go year to date. Year to date, it's gone up 18%. So people are realizing that data center expansion is going to be a real deal for these utility companies, and as a result, it's been going up in value. So in this video, I'm making the case that I don't think it's gone up enough. I think it's still a good time to buy. And one thing that I did to really get a better look at this company is I decided to break down the capital expenditures. I'm not just going off of an estimate using the depreciation. I want to pull up what is the actual depreciation on this company. Let me just pull this away for a second. We don't need that right now. So when I go to the latest presentation, what they show here is their capital forecast. This is how much money they're going to be spending on capital expenditures over the next 5 years. They're saying at this time, they're planning on $54 billion in capital expenditures. They give a breakdown, but if I scroll down a bit, they give a better breakdown. So right here, so they've got it broken up into a few different categories. So 21 billion is going to transmission. And here they have a note that says 2 billion of annual on-system capital investment is currently required to maintain existing age profile. So in this transmission category, $2 billion out of this 21 billion, is being used to maintain. That's not 2 billion just one time, that's 2 billion every year. So that means 10 out of 21 billion is maintenance. In the distribution category, it has the same approximation, about 2 billion per year, which means 10 billion out of 13. And then in the capital forecast, new generation, this is explicitly growth. So all of this is growth. They're trying to diversify their energy sources. They've got solar, wind, storage, natural gas, etc. So all 14 of this is going to be new generation. So I've totaled that up. I use this spreadsheet right here. Let's scroll over here. So I've totaled this up. So transmission, distribution, and new gen, this gives me 6 short of their 54. So currently, this is showing that roughly 48% of their capital expenditures is maintenance. However, that's about to change. You might be wondering what's going on in these two cells. Well, if we pull up one of their more recent reports here, let's see, here we go. So this is, what's the date on this? This is September of 2025, so that's this month, it's current. $54 billion, 2025 through 2029 capital forecast. Expect to announce a new 5-year plan to approximately $70 billion during Q3 of 2025 earnings call to meet the growing energy needs of our customers. And they are saying they have a over 100 billion base rate by 2029. That's approximately 8% growth per year, every single year for the next 5 years. So that's a minimum value. So they're saying it's going to be greater than 1 billion. So we should expect 8% or better. So the base rate, really quick, this is, the rate base. I'm saying that backwards. The rate base is it's like the sum of assets that they are able to pull a return off of. So this utilities industry is heavily regulated. They're only allowed to have so much money in assets that they can make revenue off of. And so this number right here, this 100 billion, a lot of this depends on regulation. So this is what they're approved for. This is what they are expecting to exceed by 2029. So just a quick little tidbit there. But 70 billion is what they're planning to hit going forward. So they're seeing more room for more investment, and that number could increase. Like, this 54 billion, it got moved up to 70 billion as more data center demand comes online. 70 billion might go up as well. So that's a little bit of speculation, but like I said, I'm calculating the base scenario here. So when I look at 70 billion, so I'm assuming that's going to be all growth. I've also assumed that this other 6 billion is all maintenance. So I decided to take the worst case scenario here. So whatever other category they weren't showing me, I just said it's all maintenance. 10 out of 21 transmission, 10 out of 13 distribution, 0 maintenance in the new generation, and then an extra 26 billion, or sorry, an extra, what is that, 54 over 70? That would be, another $16 billion goes into growth. That means now I'm looking at 37% maintenance, which means that my growth metric is now 63%. So let's go back down here, if I adjust up just a little bit more, to 63% growth, that moves my free cash flow margin up to about 18.75. So if we want to hit now, let's just say 19, 13 to 19. Oh, we really are only going up half a point here. So I had it a little bit high to begin with. So we'll just say 32.5. Give it a little bit of a bump. Okay. So here's what we're looking at. So the average analyst puts me at a fair share price today. Now, I have my own projection here where I'm using their rate base growth estimation that they've given me in September. And so I'm putting in my own 8% growth rate for the next 10 years. Maybe that's a little bit of, maybe it's risky to assume that this growth rate is going to stay on pace for the next 10 years. They've only quoted for 5 years. So that is a bit of an assumption, but I'm going to go with 8%, especially because I believe this to be their base case. They're typically trying to exceed this. Companies don't give guidance unless they're confident that they can exceed it. So I'm going to go with 8%. Now, there's no guarantee that they do, but this is a highly regulated industry. When they have revenue that's approved, it's very likely that they're going to get that revenue or those additional assets, which will result in revenue growth. What's not guaranteed is future regulatory approval. So we can't really make too many assumptions on that. So I'm going to go with 8%. So on my assumption now, or my projection, assuming 8% constant over the next 10 years, we're looking at an upside now of 7%, which is a very modest upside. However, I also have to keep in mind, what is the potential upside on this stock? Let's say that the highest analysts are maybe a little bit too optimistic. That means the truth could lie somewhere between these two numbers. Now, 158% upside on top of my 8.23% discount rate, that is a huge upside right there. Now, maybe this is a little bit pie in the sky. Maybe it's not very likely, but there's a significant upside there, and it allows me to capitalize on an industry that is growing. So finding the companies that are in the best position to grow in an industry that is growing, and then finding those companies at a fair share price is just one of my favorite investing strategies. Now, just for the heck of it, if I did in fact use the cost of equity for this company, which is 7.28, then the projections look quite a bit better. So let's just get an idea for what that means, 7.28. So now I'm looking at, for my projection, an upside of 52%, and the analyst projection an upside of now 36%. Now, this doesn't mean I'm suddenly making more money. It's the same projection. It's the same potential outcome. It's just now I'm only accepting a lower rate going forward. And so now the amount that I'd be willing to buy these companies at is going to be higher. I feel like I didn't say that very well. Hey, Tommy Shelby, what's up, man? Happy Wednesday to you as well. Glad you could join. So when the discount rate drops, it means I'm accepting a lower return, which means I am willing to buy the same stock at a higher price given the same cash flow. So the cash flow in this case, I've decided it is what it is. It's going to be one of these three scenarios. That's the cash flow I'm expecting. If I want to make less money, then I'm willing to buy the company at a higher price. That's the relationship between these two terms. So let's go back to the I think it was 8.23. So in this case, it's pretty bang on fair share price if the average analyst is correct, if The company hits the high analysts, huge upside. If my projection is correct, which that is, I'm just using their own rate base compound annual growth rate of 8%. If that is correct, the company's own guidance, which they should succeed, most likely, 7% upside. So in my mind, this company has a really good risk reward profile. The company that I'm investing in this week, $100, is AEP, American Electric Power Company. So, Tommy, did you have any companies that you wanted to look at this week? I've given my presentation on the company that I'm investing in this week, so we've got some time, man. If you or anyone else has a company that you want me to look at to put in the discounted future cash flow spreadsheet, I would do that. Let's see. So let's go ahead, and while I'm waiting, I'm just going to go ahead and pull the trigger on this on stream. Oops, what am I doing? All right. So the YouTube portfolio is up over $5,000, which is a nice milestone. The next goal is 10K, road to 10K. Hopefully we can get there as fast as possible. After that, maybe we'll up the weekly investment from 100 to 200 perhaps for the road to 20K. That way we can keep this thing moving. But okay, so we have to go to edit. I want to add a slice. AEP, American Electric Power Company. Add to basket. Now with this app, it allows you to automatically rebalance. So you select percentages that you want, and then if you hit the rebalance button, it will rebalance. Now that's not what I like to do. I like to just put the money. I don't plan to rebalance anytime soon, but it is a little bit of a pain to go back. Like every time I want to buy a new company, I have to go back and then change all of the weighting. So I mean, it is what it is. Oops. Okay. And then now that we've added our slice, I hit save. So American Eagle American Electric Power Company is on. Yeah, if you are making frequent buys and sells, I do not recommend M1. But if you like to build a portfolio or maybe several different portfolios and divide it up into different pies, if you like that style of organization where you want to see what kind of diversification you have, maybe across multiple sectors or industries, then M1 is a pretty good way to do it. It's also pretty nice for dividend investing. Of course, it has the drip feature where you can reallocate your dividends however you want. But oh yeah, okay. So now I got to scroll down to the bottom and hit buy. $100. And I do believe this company has a dividend. So I would like to see the dividend start to roll in a bit more. Because right now I've only got $8 now in cash. I used up my last $100. Okay, let's see. What is the dividend on this company? Solid dividend, 3.42. Now, I'm not the biggest dividend investor. Like there are some situations where I really like dividends. In theory, whenever I am wanting to live off my portfolio, I like the idea of dividends, especially if the dividends that I do have being paid out to me, as long as that's not exceeding what I want to pull out on a yearly basis. Because if I'm getting more from my portfolio than I want to get out in a year, then I'm going to be paying taxes unnecessarily. So as long as like the dividend is less than what I would conceivably want to spend, I do like it, because what that does is it adds a certain amount of downside protection from my investment being undervalued. So if one of my investments during a crash, if it gets way undervalued, and I need to extract capital from my investments, then I'm forced to sell shares when the valuation is very depressed. Even if the company's doing great, even if their profits are very strong, if there's a lot of fear in the market, the shares go down in value, I'm forced to sell because I am living off my portfolio. Not good. But if the company is paying a dividend and the profits are not affected, but the market is fearful, even though the stock goes down, I'm still getting dividends from the profits of the company without having to sell the shares. So that would be a situation where I really do like dividends quite a bit. Now, when I'm in the accumulation phase of my portfolio, especially if it's in a non-tax advantage account like this account, maybe dividends aren't the best because it does represent a tax drag on my portfolio. So, on one hand, the dividends are nice because it's like, it's just nice to receive dividends. It just feels good. And you can't underestimate the feel-good factor with investing. If you're anxious, if you're not happy with your investments, you're going to be more likely to sell. So some people genuinely benefit from having the dividends because it helps them to adhere to their investment strategy better. So that is another point for dividends, I guess. So anyway, I'm rambling on about dividends. I've pretty much covered everything I want to cover. So Tommy, if you have anything for me, let me know, man. Let's see. Another company I've been looking at recently, CoreWeave. This company, Tommy, you were here whenever I went over the growth stocks, right? And I was looking at my, what do I call it? My price to sales valuation tool. Here it is. CoreWeave, the more I look at it, the more it looks better and better. Do I still have it up? Yes. Yeah, it just has such a high upside. Even though, like, you first look at it, it looks like it is so ridiculously overvalued. I mean, it's got no earnings. At first glance, you're like, wow, $70 billion market cap, only $3.5 billion in revenue, and no earnings to speak of. But at the same time, when you look at the forecast, you understand. Where is it? Revenue forecast. So in 2025, they're expected to hit 200%, or we'll go with the lowest, 162% revenue growth in 2025. The lowest is projecting 100% revenue growth in 2026. This company is just multiplying. It's expected to multiply at least. If it hits those numbers, oh my God, it's going to be ridiculous. Yeah. All right, guys. That's all I got. I'm calling it for the day. Tommy, thanks for stopping by and saying what's up. I appreciate you, man. I'll catch you next week.